And then once we kind of resolved not to sell the business, I definitely remember like sleeping, but that was like tossing and turning leading up to that. And I feel like this like moment of calm came across us, which was odd because we were losing money and we had no idea how we would fix any of this stuff. But it was clarifying, I guess, was the feeling.
The following episode is with Brendan Schwartz, co-founder and CTO of Wistia, a video marketing platform for businesses. We go through Brendan's almost 18-year journey building Wistia from very humble beginnings as ramen profitable entrepreneurs all the way to a couple of hundred employees and tens of millions of dollars in revenue. They went from being venture-backed to buying out their investors and early employees using debt, very unusual, and switching to profit sharing, all kinds of interesting tidbits on what went well, what didn't go so well. And Brendan was very open with us the whole time. One last note, we did have some technical issues with the mics. Good news is Brendan sounds awesome. Max and I, a little less so, but I think it'll be fine. So enjoy. All right, welcome to another episode of Founderlicious. I'm Adam Blake, and I'm here with my co-host, Max Feinhesich. Thanks for being here, Max. And we are super excited today. We've got an awesome guest. You may notice that we're not in our usual remote recording location. We're actually on scene, on a set at Wistia. We're here with Brendan Schwartz. Sorry about that flub there.
Quite all right. Great to be here. Thanks for coming to our office and studio.
Thanks for having us.
Awesome. Well, just to kick us off, Brendan, you were entrepreneurial as a kid, as we've heard, and it seems like, went to college, did your computer science degree at Brown, decided to take a job for a very short amount of time, and then jumped right into the depth of getting started with a new company. Wistia at the time was probably just an idea. Is this something that was always in the back of your mind? I want to be an entrepreneur and that's my calling, or did it kind of just evolve and occur and happen?
That's a good question. I don't think it was something I thought a lot about growing up. My grandmother on my dad's side, her father started a knitting mill like a long time ago, and that was the family business. Unusual. Yeah. So they were there was some entrepreneurship there, although it was never talked about as entrepreneurship. And then my grandmother from her family had, forgetting exactly how many, 7 kids that then inherited and ran that family business, though my grandmother, in her telling of the story, did most all of the work. So I grew up hearing a lot about the running of business, mostly family dynamics. And I feel like there was some influence around that. And then as a kid, you do the lemonade stand, or I was always selling tomato plants or wrapping paper to my neighbors and things like that. But I probably didn't know the word entrepreneurship. I didn't think about it. I remember even in college, I feel like I was introduced to that idea, and there was an entrepreneurship class or maybe group. And probably I was in a phase of my life where I was just wanted to be different. I was like, I don't know what that is. I don't want to join some club. And I feel like was probably had some weird aversion to it, but I think practically what it meant, I think I was attracted to. If that makes sense.
So why? I mean, so when you graduated, were you thinking, okay, I'm just going to work until I can figure out a company to start, or
no, definitely not.
Okay, well, so
yeah.
Was it I'll try this thing, but it might not work out, and then I'll just go get another job? How were you thinking about
it? The candid answer was didn't really think that much about it senior year of college. I was an engineering major. I remember applying to whatever you were supposed to apply to at the career fair, and doing some interviews in a pretty half-hearted way, which obviously didn't lead to job opportunities. And then a few weeks before graduating, I think it occurred to me that, I probably needed an actual job. And a friend had sent me a job application for the company I ended up joining, which was the CEO was a Brown alum, and it was in insurance technology. Sounded very, very exciting to a college senior. But I applied, and then it was in Boston, and I came up on the train, and I met with, interviewed, and the folks, it was a small company. I didn't really think about that, but I really got along with everybody who was there. And so I didn't really think that much about it. I was like, this seems great from talking to people. It was like kind of an upstart thing and pretty exciting. And it definitely wasn't, let me do this until I start a company. That was not really on my radar at that time.
And so was it your co-founder who kind of, slowly started seeding the idea of maybe we could do something together, and that's how it all kind of brewed? Or
Yeah. This is a good line of question. I haven't actually really considered this. In college, the two of us definitely taught, we were scheming on a lot of things. I would say, like, not like, should we start a business, but like most of them were like get rich quick schemes that we never actually did. But there was a lot of
$1 million page, right?
there was chatter about that. And then when I started, when out of college, when I had that job, we definitely kept talking about that and various things. So he was the first, Chris, my co-founder, was the first person to show me YouTube. And that was like a big revelation at the time, because before that, if you want to watch video online, you need to download QuickTime, Real Player, something like this. And that was the first time you could just go to a website, click play, and it would actually work. And then that got a lot of the wheels turning that, ended up inspiring us to start Wistia, or it was, as it was called at the time, Cinematropist, which was later shortened to Tropist.
So no marketers in the company at that time.
I don't think, if you had asked me what marketing was, I don't think I could have told you what it was.
Yeah,
So.
We always used to talk about that. We had a company called Thrive, and we always said, marketing is actually a hard word. Like, what does it even mean? When you're a small business owner, like, I don't know. I think it's become more popularized, but.
Yeah, certainly. I definitely had no idea what marketing was. Didn't know what sales. I mean, I had heard the word sales before, but I did not know what was involved in that. I think our ignorance and being naive was a huge asset. It was blissful at the time that we started the company.
That's an interesting thread. So I feel like many of us, first time entrepreneurs went into a business and had these ideas of like what it's going to be like, and maybe like, you read on TechCrunch or whatever, how glamorous it's going to be. How's that kind of, concept versus reality? How many like, wake up moments did you have where it's like, oh, this is not quite what I thought it was going to be? And how has it evolved over time?
I think we say this pretty frequently, that when we started what became Wistia, we thought we would do it for, I don't know, like 3 to 6 months and get rich quick, like basically sell it to Facebook, flip it, and we'd be rich, or we would fail in obscurity and not tell anybody that we had done it. That was like our honest to God plan. So probably the first learning was, being 6 months into that and like nowhere near any level of success, but kind of counterintuitively, we were having a ton of fun doing it. Like the challenge of doing it was really rewarding and fun, which I think if you asked us at the start, that was not what we would have said,
Yeah, and so tell us more about those early years at Wistia. I think you guys were quite poor as a company and individually in terms of the amount of money you were pouring in. Totally opposite from the get rich quick. You're having fun. Like, what were the conversations like that you guys were having? Were you worried, about this generating enough income, or was that not your concern? Tell us more about that.
Yeah, I can't remember exactly, but I'd worked for a year. Chris had done freelance film work he was working in Providence. So we had some modest amount of savings, but not much. I mean, we're 23 years old, 22, 23 years old. And so that was part of this, like, we need this to be a success in 3 to 6 months, because we had these elaborate spreadsheets. One obvious early learning of this business, we spent way too long making business plans and things that really didn't matter at all. Should have just started working on it. But our spreadsheets told us we were going to run out of money, in 3 to 6 months. So personally, basically. And some of that was due to optimistic calculations about how popular this, web property would be that we built, which didn't pan out. So, right, the server costs and all of that were lower than expected. But pretty quickly after a few months, and we kind of had that realization, this is probably going to take longer than we thought, but we're enjoying it. We definitely went pretty hard into like a frugal existence. So we started the company out of a house at like 10-person house in Cambridge, where I lived for almost a decade, 9 years. And Chris lived there for a long time. So that helps, right? You're sharing the burden of rent with a bunch of friends. I don't know. I remember, most of the other people that lived there had jobs, and we all had a communal meal plan. So we go shopping together. But the two of us were there for 3 meals a day, while everyone else was there for maybe breakfast some of the days and dinner.
Any adjustments in the spreadsheet?
No, so thank you to them for subsidizing the early.
I thought they were all part of Wistia, so they were not. They were just friends that were hanging out at this house and living there. But that was not your office, or was it also your office?
It was our office, but it was friends of ours. Yeah. So our office was technically in my bedroom because I had a large bedroom at the top of the house.
That's where you had your desktop.
Yeah, the desktop with actually no, it was a laptop, but it had old CRT monitor.
So how long did it take for you guys to start getting some traction? You guys went a couple years, and then I think you raised your angel round, right? And then I think things were a little rocky. Like, talk to us about the traction early days.
Yeah, we so the thing that we set out to start was a portfolio website for artists, or actually it was a competition website for filmmakers that we then quickly realized we do not have the expertise. We don't have connections to big brands. We don't have sales experience. We should probably do something else. So we ended up launching a portfolio website for artists, and then learned the hard way, despite a lot of advice from our parents and friends of artists don't typically have a lot of money. Maybe if you would like to make a for-profit business, or you said you would like to get rich quick, that might not be the fastest path to doing so. But we were, contrarian and defiant, so we ignored that, of course. And then we, were maybe, I don't know, I want to say like 6-9 months into it, and then that hard reality set in where the savings are dwindling, and
start selling out.
Basically, we're like, we had built some interesting stuff. So it was early on in video on the web. We had built, some technology that helped you could upload any file and handle any video to encode it, play it back, and all of this. It's like kind of what powers YouTube, right? But and that was not uncommon, but there were some ways we had done that were still like novel at that time, or certainly allowing you to share video privately was something that not a lot of companies were doing. And then through the being in the Boston ecosystem, we had networked and we had talked to other companies, and actually someone who was a friend who was living in the house at the time, he worked at a medical device startup that was here, and he was following along what we were doing and helping out. And he's like, hey, what you built for artists and filmmakers to share work privately, that would be very valuable for what we're doing at work. Because they had this medical device and they had surgeons all over the world who were doing these procedures. It was all on video, and they'd record it on DVDs, and they'd send the DVDs, FedEx them around the world. Yeah, it's a huge nightmare, but that was the state of the art. And so he saw this, and it was like very easy connection for him to make, and said, like, I could, you could send this now in an hour from Brazil to Watertown, Mass over the internet, and said that's like a 2-day, it's like the fastest you can FedEx something. So he was super helpful and arranged for us to go in and meet the team there. And I think they saw the value pretty immediately. We had no idea what we were doing. So like we had like printed out pricing on like a sheet. We had like we didn't have a product at this point, which was a very helpful learning. We kind of swung the pendulum to the opposite direction after we had written this business plan and like 20-page document that was going to outline that, competition website for filmmakers that we never ended up building. We went to the opposite extreme, and like we didn't build a website this was the first version of Wistia. No website. We're like, we're going to do in-person sales only. We're going to try to get a sale before we even build this.
Yeah. There's some big things there.
It's interesting that you didn't end up like, doing enterprise sales. You're talking to this big biotech, company. You're like in their office, no pricing, no product. Like I would have thought you'd end up saying like, hey, it's $20,000 to build this for you. And then you just slowly finish up in this like enterprise, large company segment. How did that not happen?
For whatever reason, we were very set on like wanting to build something more generalized. So the company had offered that, and they looked at the pricing and were like laughing about it. Cause I think the most expensive offer they gave us we gave them was $500 a month or $600 a month or something like that. They're like, are you sure we could just pay you as consultants to make this for us? And we're like, no, you'll be the first customer of this and other people will use it. And we were pretty, dead set on that idea of wanting to build a product business for whatever reason. I don't know that we had thought about it so deeply. It was just something we were drawn to. And so that company got a great deal. And we're very happy. And we basically more or less built it to spec. I mean, there were some things they asked for that we were like, I remember they were very excited about the idea of drawing on the video frame, which would be cool. But we're like, this is, there's just being able to share the video is going to be helpful for, 90% of the people who would use this. So we did say no to some of their requests.
So I'm wondering how you think about competition. So, YouTube at that time was totally taking all the oxygen out of the air. I'm not sure when did Vimeo come around? What year was that?
That was around that same time. I think probably before us. And that was in their early days, was very targeted towards filmmakers and the creative community.
Yeah. So like I think a lot of founders would be in a situation like that, working on video and think, geez, these guys are just going to crush me. Like, why YouTube could just roll out. I mean, they do have video. Like, so is that something you worried about, or are you not somebody that worries about competition in that regard? Like, how do you think about that?
I think it was definitely weighed heavily on our minds, in that when we started, like exactly like you said, YouTube became quickly synonymous with online video. Like it's like completely ubiquitous. And that's why we were really focused on private video sharing. So at that time, YouTube was very much public video sharing, ad supported, and the competition for private video sharing was way less. So that was like effectively we're going to niche down. And I think it was also at that point, maybe reality had like beaten out of us some of this idea of like, we're going to be this overnight success. And instead we were like a little more focused on like, how could we get a single customer and then another customer? And so this more kind of iterative or, I don't know, like old school approach to business. So, and the YouTube's competition, we had a lot of our early customers asked us for the ability to share their video on their websites. And that's like ultimately what led to this pivot that is like more or less what Wistia is today, is a platform for marketers.
Yeah, sorry, I missed that.
Oh no, that's
done that video marketing platform for marketers. We've used it in the past. Great.
Oh, thank you.
Yeah.
But they had asked us for that because we had built some tracking into the platform that allowed you to see second by second how people watched. And they're like, wow, this would be really helpful for the videos on our website. And video is still really expensive and hard to make. This is in 2007, 2008. And so if we could see how it's performing, that would be great. And we said no to that for like 6 months or a year because we were terrified of competing with YouTube. Because we're like, well, why don't you use, I would say, why don't you use YouTube? Yeah. But then you hear from actual customers and they say, well, we don't want ads on it. We don't want our competitors' stuff on there. Like, we want the brand to be preserved. Yeah, we want the tracking, and YouTube's tracking at the time wasn't that good. So it was tenuous, right? And then it was really just like customer centricity, which led us to actually doing that kind of like maybe over what might have like strategically made sense on paper.
And so so you guys start following a customer, great, buildings. Okay, I'm just going to sell one at a time. It took a couple of years, I think, to kind of get things going a little bit. And so were you guys like saying, oh my gosh, if this doesn't work out, I'm gonna have to get a job, or like, no, we're never gonna quit. We're gonna do that. How are you thinking about that risk? Were your parents being like, what did you do?
I don't have to remember any pressure, thankfully, from either set of parents. I do remember having some conversations somewhere along there where we were like really skating close to the bottom, where like, because we were just like so dead set on continuing to do this, and like it was like clear to us this is what we should be doing. That's like what it felt like. And Starbucks was like it was like rising in popularity at the time. And I remember we were like, okay, Chris, like you could get a job at Starbucks. Like they have great, like really good healthcare. So like maybe we could like have some like domestic partnership, and we could get healthcare, and then like you could work and I'll keep like working, like doing the engineering on we had some scheme that never came to pass, because once we had signed up our first paying customer, then we were able to get a second and a third. And we like really quickly got to a place where we were, not making much money at all, but made enough to cover the rent and
Probably.
some food,
Shared
basically. Yeah.
groceries.
Yeah. Start to pay back some friends, maybe with a sandwich or two here and there.
I guess the reason I'm asking is, when we talk to a lot of founders early on, it's so hard to know. Some of them hit major roadblocks, and they're asking themselves, should I give up? And what they come to you and they say, am I wasting my time? How do I decide? If I'm throwing good money after bad, and I don't know how you guys really made those decisions, or if it was just more, all right, this is in front of me, I'm going to keep pursuing this until it's obvious that I shouldn't do it.
Yeah, I think it was more the former, and truthfully, I think it helped doing this in our early 20s without much, like
Much to lose.
Yeah, exactly. That was like part of the calculation. We're like, well, in this case where we fail in obscurity, or this is like some abject failure, we're like, we probably will learn a lot. That was our ingoing hypothesis. And, it's not like at that point we didn't have careers. We didn't really have anywhere to go, but, up, I guess. That's how it kind of felt at the time. So it wasn't it wasn't a hard decision.
And the flip side of that, I mean, I know that for sure we at Thrive, I've had many times when we were like, this might not work out, like, the hard conversation. But on the flip side, how did you avoid the peer pressure of like not going out and raising more money, right? Because you started, one customer, the next 2 years, things are going well. Everybody probably around you is raising money. How do you say, well, maybe we don't need to follow that path?
Yeah. I think we got somewhat lucky with some of the market timing when we did. So we raised an angel round, or we raised 2 angel rounds. So when we raised the first one, it was in, you might have this better in your notes than my memory, I don't know, 2008, let's say something. Okay, sounds right. 2008.
I do have a question. Was that mostly friends and family? Was it professional angels, angel groups? Like what?
It was some professional angels and then some friends and family. And we didn't. I mean, towards the being naive, did not know anything about investing. I don't think we had heard the term angel investing. Certainly when we started the business, and then through networking, we got connected to some people in that community, and then kind of like showing off our software and what it did. And there was someone who kind of became like an advisor and mentor to us that was also an angel investor. And so he was the person who wrote the first check and then really helped us kind of, close a round of angel funding. But the reason the timing this is in 2008. The check sizes and valuations were
A little bit lower.
Yeah. So
the
we
economy
was
already starting to show some.
Exactly. I think, that was in early 2008. So maybe before things like really went sideways, but yeah.
Close on the money, and then maybe there wasn't more to come around when you needed it next.
Exactly. Yeah. So there wasn't, I say that because there wasn't huge pressure to be like, building this up to be something that it wasn't, I think people were more like, how many customers do you have? How much could be? Like, like more into the details about how it actually functioned. So, I mean, we raised something like $700,000.
And that was in 2 tranches, you said. Was that all the first one, or?
That was the first. The combined, I think, was 1.3, 1.4 million. Yeah. So we raised that first angel round, and then we started paying ourselves salaries, which felt
Exciting.
it was very exciting. Yeah, it felt really good. I went with my girlfriend at the time on a trip for the first time, like out of the country. That felt really amazing to be able to do. But then really quickly being profitable, like ramen profitable, was extremely liberating and freeing for us. Yeah. And going back to a mode where we're paying ourselves salaries, and the 2 other people that joined us early, we were losing $40,000 a month, which was like an incomprehensible amount of money at the time to be losing. And then we also had what we called like the summer of sorrow. We were off this like real high of closing all these deals in a row. And when we raised that money, and then after we closed that round, we didn't sign on another customer until, I don't know, it took like 6 or 7 months. And I remember I set up this graph paper around the office that would just like went a little ring around our tiny office in Lexington, Mass. And we had 0. That was like what we're trying to get to break even or profitability. And we were like down here at negative, 40 grand. And we had, and so I plotted from when we started. I was like, well, here are like, 10 customers or whatever. And they're like, like it makes like barely a dent. we were really focused on getting back to profitability, but it was a long road. I remember after that summer of sorrow, the first deal that we closed, our Adam, who was like our head of sales and only salesperson, he was on the phone. It was in around one table, right? So you can hear every conversation. And so he's like clearly we can hear him closing a deal, and we're very excited. We're like, we're so excited. And we're like, he's like, well, gentlemen, I have some good news. And we're like, what happened? Like, who'd you close? He's like, well, remember that, like tooling company in Canada or something? We're like, we knew every deal. Obviously there wasn't much going on. It was like Valiant Machine and Tool or something like that. We're like, oh yeah, that sounds like a big company. Like, how many seats did you sell them? And he's like, well, about that, it was so our contact there, his son's hockey team, recreational hockey team, needed to share some video footage. So, the good news, I did sell a deal, but it's $12 a month for their hockey team. So we're like, total? So like go to the chart, put in $12. It's like a straight line across. So yeah, but then the good news is, out of that, we started lowering our prices, and we started when we started letting people share the videos on their website. That was like a big turning point for us. So we started kind of getting into the world of marketing, and that was the first, which was a funny way to get started. But there were a lot of other companies who started signing up to share video on their website at that time. So we kind of turned from like 10, 12 customers in the course of a few months to 100 to 150. And then felt we were on a better trajectory there.
Well, yeah. So did that get you to break even again, or how long did that take?
That did not quite get us there. And we did run out of money, or we're about to run out of money. But thankfully that coincided with getting this traction. So we went back to that original group of angels, and we were like, we need more money, but we're onto something. And they're like, okay, yeah, you are like, had pretty good growth there. And we're like, we're not going to need any more money after this. And they're like, we don't believe that for 1 second, but like clearly there's something here. So yeah, so we were able to close that round in a matter of a few days, which was really nice. And it wasn't a ton of money at that time, but we did, from that next $800,000, to get to profitability, which was great.
So what was the total time from founding to getting to that profitability after that second injection of cash, roughly?
So we started in 2006, and I think that second round was maybe 2010, I want to say, something like that. So I want to say 5 years, 4 or 5 years, something like that. Yeah.
Okay. So long time.
Long time. Yeah. And that was 4 people, right? Modestly paid to get to profitability there.
Who were
yeah.
those 4 people? What were you doing?
That was me and Chris, Adam, who was, he's like an enterprise salesperson. And I mean, you're a 4-person company, people do a lot of different stuff. And then Ben, who we still work with, who, I don't know what he started with his like tech. Maybe he was the VP of engineering technically to start, but he was an entrepreneur. He had built and sold a company. He was very technical, but also good. He's kind of like a jack of all trades, good at sales, did all the operations, he did basically everything.
So one of the things that we've seen is a lot of companies basically need some sort of initial hack or something that works on the traction side, that once they figure it out, that sort of propels their initial growth. Did you guys find that, or was your initial hack basically being willing to hack away at this for 5 years at a slow rate? I mean, really, like maybe that was, a lot of people wouldn't have the patience to do that.
I think that was probably part of it, like some amount of either like determination, or our expectations were low. Like we reset them and they became lower. So we were like happy with the progress that we were making. I mean, to be an entrepreneur, you have to be an optimist to some extent. So we definitely have a lot of that going. And then I think the unlocks for us were the early failure with this, like, if you build it, they will come, right? That's like a pretty common thing for people to learn. But we were like like 2 product focused founders who were like, we built this amazing thing. Oh, no one's using it. Oh, that's what marketing is. Sales. Okay, this makes sense. And then going through the other side of it, where we're like, if we can get in front of people and show this to them, like we think we can sell it. And so we kind of went to this. So like that was a big shift in mindset. And then that was addicting, like, you know, selling something, having people use it, getting the feedback and building it. I think that helped propel us. And then once we did find like that product market fit, once we shifted to allowing people to embed videos on their website early, which was again like kind of following what customers were telling us. And from like that was a big inflection point for the company.
And was that, I mean, so was it growing because of content marketing associated with that at that point? Was it just an inside sales like layup because these leads were coming in off the website? What was driving it?
It was content marketing came a bit later. For in those days, it was paid ads into like a free trial. Which was like also a pretty addicting feeling when you could, you know, you've got like some niche. I remember Cirque du Soleil, who was a customer of ours for over a decade, they signed up, like we turned on this trial experience, and in the first few days, someone from Cirque du Soleil signed up. We're like, what is this?
Wow.
And it kind of like, it, I guess, speaks more to the stage of the market, and that there wasn't, in this like tiny niche, there wasn't that much competition, right? So if you search for private video sharing or private video hosting or something like that, there really weren't a lot of people doing that. Wait, what was your? Now I lost my train of thought. What was your question?
Like basically, what I mean, you're saying that okay, we allowed people to embed the videos and whatnot, but was it content marketing, or you're saying it's ads, you know, connected to Adam, I guess, selling when those, or I assume it wasn't totally frictionless, even if they're signing up for the free trial.
Yeah, no, we still had a sale. Yeah, because we were still like building this. Because we went to the opposite extreme. When we had built the other thing, everything was self-serve from the beginning, which is a huge amount of work to actually make a really frictionless self-serve process and have it documented. Yeah, it's a huge, yeah. So we again swung the pendulum, went this opposite way. So we just slowly automated and removed parts of the process. So it was still sales driven.
Yeah. Well, I'm still intrigued, you know, that you were 4 people, you know, a number of years have gone by, you've got these customers and, you know, 2 very product focused founders, and you decide to bring on somebody to lead sales as that, you know, 4th person in the company. How did that, you know, mindset shift happen? Or did you guys realize there's this gap and, you know, these free trials are not converting, or how did that actually happen?
We had met, Adam and Ben pretty early into the switch into like Wistia mode, where we had built the private video sharing platform. And Adam was working at another, it wasn't, they weren't doing private video sharing, but there were like some analogs to what we were doing. And he was one of the first people who, like, he immediately got the market and what we were doing. And he's like, I have a lot of people I can sell this to. I'm like, oh, okay. That's like, and before, this is like the story with a lot of early employees. Before he even joined us officially or anything like that, he sold, I think, like 1 or 2 big deals for us.
Bigger than 12.
Bigger than 12. Yeah. He sold, one, Nestle Nutrition was an early customer, to do sales compliance training. So again, this is like FedExing DVDs and putting people in a room and playing it for them. They're like, oh, we could do this online. And so I had a connection there, I think related to some other thing he had worked on, and was like, hey, I think this could be helpful to what you're doing. And then that, I don't remember what the price, something in the order of like $1,000 a month. So he like closed the biggest deal that we had ever had, right? So it definitely helps when someone's like, hey, here you go. Like here, like that was like materially helpful for the business. And then I think talking with him, I think saw a path to a way we could grow doing that. So we were less concerned, even though we're product focused. I don't think we didn't have some vision. We were a little bit like, let's do the next thing in front of us, as opposed to in the future, we'll build this ultimate, product-led growth engine or anything like that.
Yeah, nobody was talking about PLP.
No, that wasn't a thing. Yeah.
So we're, I guess, roughly at 2010. Now you have a real business. You're paying some salaries. You've raised some money, so you have some investors. You got to keep in mind this thing's definitely not going out of business. Like, you're past all the ramen profitability. So then we definitely want to talk more about 2017. You get some offers to buy the business, but between 2010 and 2017, how did you guys grow the business? Like, what was the mindset? What happens? How did that go? Because you didn't raise any more money.
Yeah, no, once we got to profitability the second time and we were like actually profitable,
Yeah.
definitely our mindset shifted and we started thinking, I'd say more ambitiously, started thinking farther out, and we started investing in things that weren't going to have an immediate payback, right? So if you're doing like paid ad spend, you can track that immediately and know, okay, that dollar I spent here is turning into two. And that is the period where we started doing more content marketing.
Okay.
And a lot of that was, I think, driven by, and the same with what was product led growth before that was kind of a named thing in the industry. There was some inclination of like, this is how we like to interact with products, and this is like what feels good, and this like ought to be the way the world worked. So some of that was, and it was, now it's very commonplace. It was like counterintuitive at the time to say, hey, we're going to make videos or blog posts like teaching people how to make videos. We're like, well, that's something people pay for, like, you could charge for that. And we're like, well, I think if we do that, and it'll like engender, goodwill towards the brand, and then more video in the world is good for us. Like, we'll capture some absolutely minute part of that at the time, but it's good. And so those things, and then the evidence that it's working, it starts with anecdotal things, right? So we make a video, email it out to the mailing list, and people say, wow, that's really great, or I learned something. Like, it starts really small, but if you keep at it, that type of investment compounds on itself. So um our biggest channel now is still word of mouth. So it was like started with a product that solved problems for people, and then I think layering on content marketing, video content marketing is pretty differentiated at the time, and that had like huge helpful effects with, we were using our product as customers for the first time, which felt really good. And yeah, doing, I'd say, a lot of content marketing, and then we like got, I'd say, good at marketing in that era. So a good self-serve product that worked, combined with like interesting brand marketing, content marketing, is like what was this engine of growth for us during that period.
And so you're bootstrapping. What were your growth rates during those time periods, like revenue on an annual basis? I'm sure.
Oh yeah,
varied, but what
I can't remember. We're definitely doubling like every year
so you're
for
doubling.
yeah.
So healthy growth rates, definitely fundable. Like, were you guys having conversations? Should we raise more money?
I don't. I'm sure it came up. I don't remember ever like really seriously considering that.
Yeah. I mean, you could have raised a lot more money, right? And at that time, 2011, 2012, 2013, the market was doing.
Yeah, it's a good question. I think we were more in this mode of, at this point the business became profitable, and it became like more and more profitable. So we were having trouble like investing the money back in, like at a rate that was like commensurate with that growth. And so that was probably our focus, versus, is a similar, if like, okay, we were raised $10 million or something, what would you do with it? We're like, well, we have $10 million. Like, we're like,
so you have built up 10 million?
Probably not 10 million, but we had like a few $1,000,000, like, fast forward a few years, right? So we're pretty profitable.
So yeah, you definitely don't need more VC.
We didn't need the money, yeah, which is a like great position to be in. But I don't remember the answer exactly to your question of like, certainly there would be other reasons to do it, of like, well, we could do even more money, or we could, really go, big with this.
You guys are unusual, right? I think most founders in this tech ecosystem that were at that place in time with the, growth that you guys had, and the, I think most of them were raising VC. And so I think it speaks to your unique DNA that you guys weren't. And I think that's interesting. That, something in the story there caused you guys to do that.
Yeah. We certainly, that was also around the time that we made one of our largest mistakes. Well, being more and more profitable, like that seemed good to us, as it is come back in fashion. But in talking with, we did meet with investors, talking with other people in our network who were, smart people who were far more successful than us, and more seasoned at doing this, would kind of all give the same advice, which is, businesses like yours, you are a growth business. You're valued based on the rate of growth. like you're growing really rapidly, but you have all this profit. Like you should invest this profit back into the business,
Why do
and
you
you
have
could
all this
grow.
profit?
Yeah,
Get rid
exactly.
of it.
Yeah, they're like effectively you're mismanaging the business, or you're missing this big opportunity. You should invest that back into the business to grow faster. And so,
But you didn't know what, I mean, that is a good question, right? A lot of founders, it's like, okay, when the next 10, 20,000 in ARR or MRR comes in, I'm going to hire my next person. There's most startups, they're always like, I just am one more person away from what I want to be, right?
Yeah.
So why wasn't that the case for you guys?
I think we were for a period of time, and then I think then like growth really kicked up, and we were expanding but we were, I think not like being hyper aggressive with what we were expanding as we saw fit and saw the need of what you could do. And some of that's probably, I think, like lack of experience or what kind of made sense on the ground for the business at the time. But when we heard that advice, our first reaction is, it's probably typical of like the controller, like, wow, these people don't know what they're talking about. And then you hear it enough and you're like, wait a second, like
maybe it's right.
Maybe it's right. And like, we should, be more open-minded to this. And so we made a conscious decision to change our approach and started, instead of hiring one engineer, we'll hire three. And instead, like, where should we be advertising? Like, let's do some like more stunty stuff and get billboards. And the fun, yeah, I don't know if we went into that market, but definitely hit the Northeast. We went, we spent, for us at the time, a fair amount of money. And kind of the thing about that was, like, especially, I don't know what the word is, nefarious, or no, that's not the right word. When you're talking to other people, and they're like, how's business? You usually don't talk about revenue. You talk about how many people you have or something like that. So
after you say it's great.
Yeah. Oh, it's great. But you're like, oh, we just, the team grew from 20 to 40 people. We're like, oh my gosh, like that's really, amazing. Right. But you're not talking about unit economics or how all this stuff is performing. You're just talking about these vanity metrics effectively.
Revenue per employee was not a thing.
That was not a thing we were tracking at the time. Or, oh, I saw your billboard, like stuff must be really good. So you get like all this like positive affirmation or feedback that feels really good. And like that got us like kind of deeper into this spiral. So at first it's good. And I think, we're probably making some good decisions. And then what happened to us is, you invest expecting a return, obviously. And I think we didn't probably fundamentally understand how the business was working and how much, especially in software as a service, how much how much revenue you're going to do this year is a product of the work you've done the last like 5 years or something like that. There are momentum businesses. It's pretty hard to shift and change.
Very predictable.
Very predictable. And once it's going, it's a really great thing. It's like hard to change that rate. And I don't think we had a good intuitive sense of that. So spending, investing. And the business is still growing really strongly through this period, but just the increased investment is not, the growth rate isn't changing commensurate with that, I'll say. So basically all projections are wrong. So, we're like, okay, we'll invest whatever down to go, we'll run this break even. But then when you actually play out the year, the like revenue doesn't tick up, like the J curve doesn't, you don't find the end of the J. You're just kind of like running how you were going to run. And so we found ourselves in a place where we were like really profitable, and then that profit eroded because we're spending all that money investing back into the business to a place where we're losing money every month, which is okay because like you've built up some cash reserves. But after like a number of months of that, where those like what the money we're losing goes from 20 grand to 40 grand to 80 grand to 200 grand, like okay, we will go out of business like if something doesn't change here. And then that started shifting like our mentality, how we were running the business. And like all of this happened, I'd say, slowly and not like in the background. You're not like super conscious of it. It's like the frog being boiled. So for this period of time, like you were talking about, where we had effectively this feeling like effortless growth and investing in all these long-term and creative projects, we then found ourselves in a place where we were losing a lot of money, And we're like, okay, we have to turn this around. So you just look at what you're investing in. You're like, all right, well, we got to turn this thing around. So like, what's going to take up the growth rate as fast as possible? And I think we still hadn't internalized, exactly the mechanics of how a SaaS business works. And we're like, okay, well, first thing to go is like all these creative, projects, because these are expensive and like they return, but they're not going to return immediately. And started shifting our attention to, a lot of short-term tactics and like growth hack type stuff, which is like has its place certainly, but like in a portfolio of things that you're doing.
It should be like some portion of what you're doing, especially at that stage. You don't want to disrupt the train from going down the so.
And we just definitely disrupted the train from going down the tracks at that. And so I feel like I don't know if this is actually in my memory, the like low point of this was we we're coming off of doing all this like longer term creative work that we were both like the two of us were really proud of, and a lot of people at Wistia, I think that was the reason they joined, to sending an email to the whole company saying, all right, put your ideas for like ways we could increase revenue in the next like 30 days into this Google spreadsheet. We're going to rank them and then we're going to just do them next week. And I like think back to that and I'm like, that was really, really lost our way there.
Yeah. For anybody creative, that's like gotta hurt. Rank it.
All creative.
Oh yeah. Yeah. I don't know if it was like that extreme, but that's like effectively what happened. And there was like a, big, kind of vibe shift internally towards like, all right, we got to get revenue moving here.
Do you think that maybe there was just lack of patience? Had you continued on that track of investment and these were like long-term ideas with, it takes a few years to play out, maybe that could have worked and it's just you didn't have the cash, reserves to see them through?
I don't think so in this case, because I think what was effectively happening too is we were mismanaging the business in that we were just saying yes to more things. And so we weren't really being very disciplined about stopping things that weren't working. So basically inefficient growth. Yeah. So anyone, there was the core of things that we should have been investing in doing more of. And then it would be like anyone with an idea, or like, we should do this. This could help us. Yep, do that. Like, in this mode where we're like, oh, we have a lot of profit, we need to invest it back into the business. So we weren't being, I think, very disciplined, or like scrutinizing what we were doing, or like, is this actually working? So we had all these, way more projects, I think, than we should have had going for people. And then, everyone gets spread super thin, and then the things aren't going to work. We basically lost our focus, I think, is what happened through that period.
Do you think that, through the arc of raise the seed round, get to stability, profitability, start, listening to the crowd and saying like, yeah, maybe we should reinvest. Was there ever like, you and Savage getting maybe bored with what was going on, and so like trying to change things up to get excitement back into the business? Or was it kind of just happened because of the peers around you?
That's a good question. I think some was definitely self-inflicted of like
14 years, right? It's a long time.
Yeah, of like wanting to change for change's sake. I think a lot driven by looking at what other people around us were doing and thinking we should be doing something different. We should change. And that, like that, I think in general that's good. Like that has also served us well in other instances. But I think in this case, it was we were looking too much to what other people were doing, I think, and lost our focus in what had actually driven results and had made the business successful to date.
So you did get to a point, as I alluded to earlier, 2017, where you got 3 offers to buy the business. Had you corrected these problems prior to that? Was the
absolutely not.
So oh man, rewarding bad behavior. So less profitable, and that got everybody excited to buy the company.
Probably wasn't that. I mean, we were still we were still growing like really significantly through that period. It's just not as efficiently, and I think doing a bunch of stuff that we shouldn't have been doing. And I think as a result, the two of us and probably a lot of people at Wistia who are more creatively motivated or maybe joined for some of the focus that we had in like that previous incarnation, I think we're probably becoming, or I could speak for myself, we're certainly becoming depressed basically of this is like suddenly became a lot less fun and fulfilling to do. And yeah, so when we receive, like, along that growth curve, we had other inbound interest, right? Because I mean, there's a lot of M&A stuff going on in tech, and it's like pretty frothy. And for those, we just be like, oh, we were having so much fun. It's like the polite decline for all of those. And so these came in, they happened to kind of be clustered, and it was at a time where yeah, the two of us were not having a good time.
Yeah.
And so that was what prompted, like, oh, should we take a look at these? Yeah, maybe we'll take a closer look.
The declining the earlier ones, okay, you said you're having fun, but from an outcome perspective, were you already convinced, no, this is going to be huge, this is going to be $1 billion company? And so to take these offers, because I mean, you guys have been at it, you had already been at it for a while, like, you know, that'd be tempting to anybody depending on what the offer was, of course.
Yeah, I don't think we received it. I mean, it wasn't like some cold email with like an offer for, you know, like, let me buy your business for like X million dollars. Yeah, it was like poking around, and we would just be like, oh, we're pretty focused. Yeah, like, let's talk in the future. We're pretty focused on what we're doing. It was be something of that nature. And that's probably like the three of these like started in a similar vein. It's just instead of we're having fun and we're, you know, doing this, it was like, yeah, maybe we should, you know, to see what other options are out there.
So obviously you didn't take the offer or any of the 3 offers. So you're 11-ish years in, kind of depressed about the direction. Sounds like some of your employees are. I would imagine some of them are leaving. I mean, sounds like a great time to take an offer to get out. It didn't happen. Like, tell us more about that.
Yeah, that was I mean, it was probably like a, I don't know, 3-month period or something like that of, I feel like Chris and I doing a lot of soul searching and deliberation about what we wanted personally and for the future of the business. And it was spent a lot of time walking around Cambridge. And I feel like each day went something like this, like one of us would wake up and be convinced that we should sell the business, and the other person would wake up and be convinced that we shouldn't sell the business. And we would like try to convince the other, and then we just like keep switching positions. This is like, I feel like something that happens kind of frequently in our like co-founder relationship of like trying on the different, you know.
Max and I do.
Yeah, very familiar.
Yeah, so, you know, it's like, so we did it. I mean, it probably was like, I don't know how long it was. It was just, it was emotionally intense. So the way we like finally reached clarity on it was like a conversation that was like, okay, let's imagine we sell this business. And it was at that point like successful enough that the amount of money, we wouldn't have to work again. So that's very nice. But we're like, okay, we don't have to work again. We love working together. We think there's a lot of, we'd start something again. Like, what would we start? We're like, well, you know, we were like rattling off all the opportunities in B2B video. So we're like pretty passionate about video and marketing and business. And we like know that space well and think there's a lot to do there. And we're like, okay, who do we hire? And we're like, email these people. And we're like sitting right outside of Wistia. They're like, all these people work at Wistia. We're like, we'd really like to make a creative, like, you know, brand, like a good, and we're like, what are we? We're just like we're describing Wistia. Like we would sell Wistia and then rebuild it anew without these like problems that we have. And we were also calling like our network and seeking a lot of advice during this time. And it was interesting. It's not something I would have thought. It makes sense having gone through it. But if you ask, you know, people in your network, if you're considering selling your business, like, you know, should I do it? Like almost everybody says like, you should do it, you know, like, especially if you haven't had that level of success. Like, no one is going to stand in the way. No one wants to be the person who said, don't do it. And then it goes, yeah. Like,
I think from the outside, you know, especially if people aren't that close to the business, they just look at risk. You know, there's risk here. You got an offer. It's good. Go for it.
Yeah. And we had questions about the future of the market too. I don't think we were, you know, at that point we were like, this is so easy or like it was going to be hard. But there was someone in our network who gave really helpful advice. He was someone who had sold his company and did really well. He didn't have to work again, but he was like super honest about like the hard parts of it, and how there were like some pieces of it he regretted. And one thing he said that made perfect sense, it did not occur to either of us. He's like, hey, so you're telling me all these problems like you have with your business. he's like, I had the same thing. And when I sold my business, I have a boss now. And like, I'm telling the boss the problems of the business. Like, they see the problems with the business. And guess what? They say, okay, now you fix the problems with your business. And you're like, okay, yeah, I guess that's my job. I will fix it. And so he's like, I fixed all these problems. And now I don't own my business. I just fixed them for somebody else.
Right.
And we're like, huh, that's interesting. You know, at that point we raised that angel money, but we still had complete control over Wistia. And it was like I'd say a humbling and kind of funny experience to realize that you're like, we have agency to fix, you know, these are problems of our own making to some extent, or certainly we have agency to fix these problems, which probably should have been obvious, you know, all along. But there's something about that. It's like a moment of clarity, I suppose. We're like, okay, we shouldn't sell this business. We know what's wrong with it. We can seek to change these things, and we're like confident in our ability to do some misplaced confidence. Like, we have confidence that we can figure this out. We don't know how we're going to do it, but and then once we kind of resolved not to sell the business, I definitely remember like sleeping, but you know, that was like tossing and turning leading up to that. And I feel like this like moment of calm came across us, which was odd because we were losing money and we had no idea how we would fix any of this stuff. But it was clarifying, I guess, was the feeling.
Well, okay. And then we should definitely talk about the debt. So maybe you can talk about that, right? So you did have to deal with the investors, right? Because the investors wanted to sell. And so talk about how you did.
Yeah. So that's like the next day, I feel like after we made this decision, we were like, okay, well, we're now misaligned with investors because people knew that we were considering this. Investors knew. And also employees, because employees had stock options. Like, that would be a good financial outcome for everybody at the company. And so there weren't like so many options really. Like, I mean, we can just say tough luck and like try to go forward. That wasn't really, I feel like, ever our style. It was like try to do right by everybody and maybe reset expectations for what, you know, the future would look like. And the first option I think was clean up the cap table, like raise another equity round. Yeah. And, you know, people who want out can get out, and employees could sell shares, and that's like a pretty common thing. And most of our network, that they have experience in equity, like by and large. Debt is more common now in software, but was pretty uncommon. And it was really, I think, thanks to our COO at the time, who was definitely like into some like exotic maybe deal making, or like that was like an interesting challenge, I'd say, to him, because we were like, maybe there's an option. I don't even know how we came up with this idea. We're like, maybe we could get debt like to do this. And we started exploring that option, and we ended up, there were a few companies who would do deals there in software, and it was like a more nascent industry in the world of debt, because you basically have to understand, like, these companies kind of realized the mechanics of a SaaS business, and like that you could, you know, make them profitable. So like they could figure out how to get the, I don't know, I'm not a fan of risk adjusted return, like figure all this stuff out. So we talked to some of those folks and then started getting some term sheets for that. And the piece about that was very attractive to us was, it's like something about Wistia, like an independent spirit. Like, we want to do our stuff our own way, and kind of be in control of our own destiny. So the debt option is attractive because it's like, they don't care what you're like, they just want to be paid back. Like, they're not experts in how you run your business. Like, they're not going to have advice about how to do that unless you're like breaking your covenants or something, and then maybe they'll be on you.
It didn't come with a board seat.
Doesn't come with a board seat, exactly. And it was like one deal. You can do one deal and be done. There was definitely this feeling on the equity side, you've got partner risk, you're going to have, board seat, more control. That to us felt like we probably weren't going to be able to run it the way we wanted. Probably because at the time we still, I think, still had like a lot of instincts, but like maybe not conviction about how some of these things could be done. So I think in the presence of someone with like really strong conviction on the board, we were like, okay, well, I guess we'll do that. So we felt like that wasn't something we wanted, and also this feeling you're like on a treadmill, right? You do that equity deal, and then that person's going to need a return, of course, in like a number of years. And I don't know, that felt burdensome. So we found a great partner on the debt side, and it was, I don't know, it wasn't like as scary as it like presented. Like I feel like when we told people this, they're like, oh my God, like you're raising, like, because I guess effectively you could lose your whole business. Yeah, it could go, you know, if you can't service the debt, like you're done. Like and so some of that, there was like some getting comfortable with that. Like it was definitely, I remember a lot of like talking about like, what happens if this happens? What happens if that happens? And, you know, and those companies like they don't want to take over. They just want to be paid back. They don't want to run a software company. So that's like not the first thing they reach for. And I would say in our case too, so we raised $17 million in debt.
How much revenue, if you can share, or what other stats around the business?
I can't. I feel like Chris and I have like a shared brain, and I'm like, that's like in his. We were probably, I think we were doing less about that in revenue, maybe something on that order of magnitude, and we were losing a few $1,000,000 a year. Okay. And so so
what was the debt service on the 17 million a year?
I want to say it was like, it's like probably like 10% interest. So like, I don't know, $2 million, something like that, maybe.
Okay. But on 17 million in revenue, like that's a number that you could get your head around.
Yeah, it was possible to serve, but again, we were losing money. Right. So that's like not a great scenario, and you know, didn't have, and all of that debt was, I don't think any of it was primary capital, right? So that's all being paid out to employees and to shareholders, basically. Yeah. And so but the other helpful thing about that is it helped us focus in a big way. And then it felt like after we did that deal, it felt more like we were playing the game that we knew. And so we like I feel like probably didn't have it like super, you know, laid out or well articulated, but we we had always run the company open book. And so we were like very open about how the debt deal was going to work, and, you know, and all of this. And like the team, I think, really rallied around that. It was like, in some ways it was like this existential threat of like, okay, if we can't like get this business to profitability, it'll go away. And so that level of like scrutiny and focus, I think, really helped. Like we got a lot more efficient. And there was definitely a lot of like cruft in the system and like overspend on all kinds of stuff. So there was that, and then like return to kind of like focus on the customer and the core business in order to make it work. And so in 2017 we did that deal, and so we losing a few $1,000,000 a year, and then the next year got to profitability. So
with the debt service.
Yeah. Wow. So it worked, which was really.
That's amazing.
Yeah.
So, I mean, there is one thing you left out with all this advice you're getting about selling the company, right? Which is there was the opportunity for you guys to never have to work again, right? Which, but did you guys end up taking any money off the table? Either, I don't know, through a profit sharing or through this debt deal? Did you sell some of your shares?
We sold a little bit of like our shares, which was helpful because we hadn't taken, we were taking salary, like, but not market salary, and had never, been,
So maybe you took a little off. You can buy a car, get a down payment on a house or something.
Yeah, it was like a down payment on a house, kind of amount of money.
Ease some of the burden of like, hey, I probably could have earned a lot more money in the last 11 years by taking a different path out of Brown, but you nowhere near anything that you're gonna quit working on what you're working on. Yeah, and I think the mindset at the time was if we can keep working on this and compounding it, and we had a lot of optimism like that we could continue to grow the business, that like even in a downside case where we're forced to sell the business, we probably would,
Yeah, and we're in a very fortunate position at that time. The business had achieved a level of success to do that. So, yeah, I think it took a little money, and that's helpful. And like Chris and I are both starting families, right? So to be able to buy a house was a big deal. And then, yeah, we had also said at that time to the shareholder, because we didn't buy out all the investors.
Yeah. So like, who stayed in? Like, what percentage of employees did they all cash out? Or like, what happened?
Yeah, all the employees cashed out. It was like we had sold the business, and then we converted to a profit sharing model. If I remember correctly, I think we were doing 10% of EBITDA would be distributed pro rata to employees based on salary.
Okay.
And then the investors, a few cashed all the way out, and a lot like took out maybe, you know, the money they had put in or some multiple of the money they put in, and then like let the rest ride. And I think a lot of that was people were like, you know, we still believe in what you're doing. It was more of like this expectation reset for them. And we also said, you know, the way we converted, the investors have preferred shares, they all convert to common in this deal too. And then so part of that was like, hey, we want to run this business for the long term, and we're kind of in the same pool here, right? So like if we get paid, you know, via doing some like dividend distribution, right, you all get paid. If we end up selling the business, like then all that is aligned. But we yeah, had kind of wanted to get more into what we felt was like a sustainable growth model where we were doing the profit sharing for employees, and yeah, and that worked well.
Just like you took a little bit of an orthodox path, right? Like take that, cash out the investors. There were a lot of positive consequences with the team. Now everybody's aligned, people are excited, and getting rid of all the inefficiencies, business is back to profitability. On the other side, were there any unexpected consequences of not taking the traditional path and kind of doing this thing that maybe is a little less normal? I imagine some people must have left, some good people.
Yeah, I think there was that definitely happened. It was a pretty turbulent time. I think because we were growing really quickly, even though we hadn't raised institutional money, it was like that was the vibe, right? Like fast growth, early stage startup. And when we took the debt, and we were like, we're going to slow down, not that we were trying to like make less money, but we're like going to slow down. We're going to reinvest in some of these longer term creative projects that, and it wasn't really clear what the future of like, could we get to profitability? Could we meet these new like debt service pay? Like, some people, I remember we have on our Glassdoor page, there's like someone who like wrote a review at the time, was like, this is a sinking ship, like get out while you can, or something to that effect. Yeah, it did definitely hurt at the time. Which is like, yeah, we were as transparent as we could be, but you can't predict the future. So we can't be like, this is going to be perfectly fine. So I think there were a lot of people who maybe, with slower growth, like that didn't line up with what they wanted in their career. Maybe if they wanted to take a next step and become a manager, and we're going to be hiring a lot less, right? Like those opportunities are going to be less available, or you think the company might be going out of business because there's some, other motivations behind the scenes. Like that's, I can completely understand that, right? You have the information you have, and you've got to make those decisions. So it was a big change internally. I think it was pretty confusing for a lot of folks. So there were, I think, some people who'd maybe been at Wistia for a long time, who'd been around for that kind of like creative, Renaissance era of the company, who maybe, had more of a relationship with me and Chris, and were like, oh, I see what you okay, you want to get back to that. That was exciting. And like a set of folks who are just like, I don't know what this is. Like, I don't want to be here anymore. Yeah. So there was definitely a lot of folks coming and going, I think, during that time.
And how did the profit sharing work as a motivator? I guess you're sharing 10%. You told everybody we'll share 10% of EBITDA, but I mean, if I'm an employee, I might be thinking, well, I don't even know what the EBITDA is going to be. I don't know what my share is going to be. Like, is it going to be relevant to my salary? How did that work out?
I think that was challenging too from the team standpoint, because I think when we said we were going to do this, we didn't even have those like numbers or figures, and we certainly weren't profitable.
We're
We're going to do profit share. Yeah, that's like what was our vision, and we're like, we're going to figure this out, right? So people are kind of taking a flyer on that one, and I do feel really good where that ended up, because when we got back to profitability and then kept growing that way, like almost everybody except for maybe people who are like really early and have more significant equity stakes made more from over the years from the profit sharing than in the sale of their options and equity, which I think like speaks to a little bit about like how some of these work unless it's like an outrageous exit. You know, because we had did this buyback at like a market rate for the business, which is like a, you know, I'd say a very good outcome for a business of our size. And like people did pretty well, but most people made more money from the profit sharing
And so
each year than what they would have made in a sale.
that's amazing. Each year they were making more from the profit.
Yeah, if you were someone, I'd say, who were like a more entry level employee, especially. Yeah.
So like what you know, was it a 30% bonus, a 10% bonus, a 50% bonus? Like how did it?
It was probably, I think, like around 10%, maybe 10.
But,
Yeah.
But that kept coming in, and these guys ended up earning a bunch of money.
Yeah. And then and also during that time and before of like, you know, is our flat like pay market rate and start like smaller but talent dense team and pay like near top of market. So people's salaries went up during that period too over time.
So is this a path you'd recommend for other founders? I mean, a lot of businesses are moving to try to be profitable now through choice or not. Right? So like if you were starting a company right now and you were at those early stages, either you raised some capital and there's no more coming in, you got to get profitable, or you're just starting. Is this something you'd recommend to them?
I think so. I mean, it's like I said, I feel like talking a lot about advice that we, you know, didn't take or took at our own peril. So, but I have found for us, it's been very grounding. Like at some point in a business, this is arc, right? Like understanding how it works to run a profitable business, I think is a very valuable experience. And certainly in a time where access to capital is harder, like there might not be more money coming in, getting more efficient, like for me and for Wistia, I feel like it forces a certain level of focus. And I feel like that is healthy. When you have that discipline and focus, it is almost always a healthy thing. There's like an unhealthy version of that where you feel like you're really starved for resources or you have to make some really hard trade-offs. But I feel like for the most part, for us, it has just driven, focus and efficiency and like a better connection with how the business actually works and what's happening, and like less of a chance of, I don't know, getting into like la la land or like deluding yourself with like things that like might, you know, could pay off in the future or something like that.
And then for the employees, profit sharing, like I think you guys have also shifted your plan a bit.
That's true. We've come full circle. We don't do that anymore.
So you don't do that. Okay. So then how should we think about this, right? Like if you're talking to a founder, like should you know, how do you balance equity versus profit sharing in this world? Like, how do you think about that?
Yeah. Well, if it's helpful to tell like how we got full circle. So like for us, it comes back to incentives and having having everybody be aligned. So like shareholders, us, folks on the team being aligned with what we're trying to achieve. And so the profit sharing mode worked well when we were kind of continuing to grow, but a little bit more modestly. We were building up profit and becoming more and more profitable. So that's what we wanted, and that was working well. And then in late 2020, we shifted our company strategy. So for a long time, I'd like describe us as a video hosting platform for marketers. And we were really focused on that. We wanted to do that really well. And there were a lot of other adjacent opportunities that we said no to. So people had always asked us, could you help us with webinars? Could you do live video? Could you help us create videos? Could you help us edit videos? And so all these were like, no, like there's a big market there. People are doing it, you know, good enough. Like we don't want to do that. And in 2020, we did a big market study and kind of put our own conceptions of like the market and what customers wanted aside, and worked with an outside party to do this. And like overwhelmingly what the market was saying is we would like a lot of these video tools to be from a single provider. Like it's just super fragmented experiences using all these different things, and it's almost always the same person or set of people who have to stitch these tools together. It's like hugely inefficient, and there's like a pretty big desire to have a single vendor or platform that can do that. For instance, live video and putting it on your website or distributing it, or being able to edit a video in that platform. And so when we switched course, in order to actually do that, it was going to mean a huge expansion for our product footprint, which means we're going to have to hire a lot of people. So we doubled our product design engineering team probably in 18 months. Wow. And that's like expensive. It's just expensive. So at this point we were quite profitable, so we could afford to do that. And so that was like a conscious, we're like, this time we had learned from some of our mistakes. We're like, we're not going to like dip all the way into the right, but we're going to like spend down profit to be able to do this. And that's going to produce this return in, 5-10 years. And then when we made that decision, we're like, oh, we're like misaligned. Well, that came too. Yeah.
Profit to share anymore, right?
Exactly. Yeah. So we're misaligned. So this profit sharing program is, people are going to go from, like a 10% bonus to like a 1 to 0% bonus. And so at that point, then we said, well, one, I probably went on some like boondoggle that basically I was like, okay, so we're reinventing equity here. Like that's, like what other like structures could we have that could like incentivize people on the growth of the future value of a company? We're like, oh, this is why options exist. So we kind of begrudgingly were like, all right, we're going to return to this. And we were like made some like adjustments that we were like kind of annoyed us the first time related to like how our options program worked, like some small tweaks. But basically we ended up back with what looks like a pretty traditional stock option program.
I'm curious, what are some of those tweaks, if you can share?
I mean, they're not like super exotic, but if folks have been here for a long time and they leave, like the board can grant them like an extension. So you don't have a 90-day window. You can have, right? So if people don't have the cash to
months or whatever to get the money.
Yeah. So in this case, so for some people who've been here a long time and have left, we extended it to 10 years or like the limit for it.
I mean, a lot of companies made the mistake of lending people to exercise, and that has not gone well.
Yeah.
A lot of people.
That is a tough one. And the other piece that we've said that we haven't made good on yet, but are still working to do this, is we do like believe a lot in sustainable growth. We want to do this for a long time. And one thing that was always tricky with the first option, people are like, what's the end of this? Like, when are we going to, how will this turn into money? And now there are some, like I think SpaceX does this. There's like other companies who there's like periodic points of liquidity. You can stay private, but either through like tender offers or
they do secondaries and give some liquidity to employees.
Yeah. So I think that's what we still haven't figured out that path, but that's like what we would like to do. So I don't know, let's imagine like every 2 years, there's some point where, maybe you have something in your life, your kids are going to college or you're buying a home or you need to buy a car. You could, elect to sell,
and the company would buy those, or outside investors would buy
that's what needs to be figured out, right? So yeah, if we're running in a mode where we're more profitable, I think we would probably want to finance that ourselves, or maybe we would, and it would be modest, right? Because you can control how much you're going to do there, or perhaps we find, some outside partner who's willing to do that. Let me know if you have, we're working to figure it out.
No, I think these are questions that everybody struggles with. Telescoped, we're running profitable, and but it's that question of like, how do you balance the growth with the profitability and the needs of the employees, and we do have shareholders, just like you did early on, and it's tricky, which is why we're asking you how you did it.
Yeah.
Okay, so 2006, $0 in revenue, just getting started. 2024, you're almost 18 years in. I have no questions. So like, whatever you're willing to share about what's the status of, the state of where Wistia is from a numbers perspective, where you are from a personal perspective. It's a long time to be with a company, and like, where are you going to go with this?
Let's see. We're around 180, 185 people now. So we've grown the team a lot since we did that. I think when we did that debt deal in 2017, we were like 80 people, 85
Wow. Okay.
people. Yeah, and we continue to grow. Yeah, customer number and revenue has continued to grow, and we've expanded the product a lot, right? So now we're doing live video. We have a native video editor. We have ways to record and create video in Wistia, and those are much bigger markets than the one we've been in traditionally. So again, towards being, you know, an entrepreneur, being an optimist, or like see a really big path for growth in the future. What was your other question? How am I doing personally?
Yeah, like I mean, so we had Art Pappas on the show, and he's been at it. What was it, 24 years or something?
Yeah, that's incredible.
And so, you know, it's like, geez, are you going to keep doing this? I'm sure people want to know. You know,
what do you say?
Like, well, he's still having fun.
Yeah,
I actually believe him that he still wants to do it.
Yeah.
But that's unusual. So, you know, are you in the same boat? You want to keep doing this, or, you know, like, how do you feel about that?
Yes, I am having a lot of fun right now. And it is interesting because it will come to an end at some point, right? Like, you know, our lives are finite and, you know, or things change, right? And, but I feel like, it feels right now we're operating the best that we've operated in, you know, since we've been around. Like a really great team that is highly talent dense. We've been on the same a lot of this is like compounding things. We've been on the same strategy and been focused for a number of years, and we're like starting to see these products start to get traction in the marketplace. And that is a really, I mean, you all are in the same. Yeah, it's a really addicting feeling. And I think there's a piece of that that's like a product, like loving product and wanting to build a great product, have people use it. That is hugely rewarding. And I also feel very fortunate that, Chris and I have a great relationship and still really enjoy working together. Like that's a big source of, I don't know, motivation and joy in the business. And it's also funny. I feel like doing this for, almost 18 years, there's definitely seasons to it, right? There are like some times that are really hard and challenging and fraught. And there's other times that feel, I don't know, just like really fun and energizing and joyful. And we are certainly in that part right now.
Yeah. So it's a good time to ask you the question.
It's a good time to ask the question, but I also find myself asking of like, well, this doesn't last right? Like it doesn't last forever. And so it's kind of hard to know, I guess, what the future holds, but I feel like we're enjoying the ride right now. And see, like, I think a part of that is like seeing a clear path to how we can grow the business like really substantially, which is, is an exciting place to be.
Yeah. So you've increased the TAM. So you're seeing a ton of growth ahead of you. So then people are going to start to ask the next question, right? Which is, where do you go with this? Is this a forever business that as long as you guys are excited, you and Chris are going to run it and keep it private? And as we just discussed, have secondary tenders of some kind to give people liquidity? Is there an IPO at some point? Or in Art's case, PE came in, right, and bought the business, but he's still operating there and he's loving it. He loves the PE guys. So
that's great.
Unusual. Right?
That is unusual.
He genuinely loves them. So, what do you think is the path, or maybe you don't know?
I don't know. These are the conversations that we're, I feel like we're having now. I think the path is towards sustainable growth is what we would like to do. Is figure out some of the secondary piece and how this works, and then I think in that sense we would be, we're growing, we'll be able to increase growth rate, do so profitably, and be able, like, folks can get a return along the way at that point. And then from there you can make any there's optionality, which, there's downsides to optionality too, but for the most part, that's good. It's good to have the optionality. Or I feel like there's a thread through all of this is like when we are in a place where the business is sustainable, like the sustainable growth, I feel like the two of us, make the best decisions and the most confident decisions. So there's some kind of like psychology for how we want to run the business. And there's something, at least for me, that's comforting and like makes me want, like increases ambition when we're coming from a place of like, oh, all these pieces are solved, or like you could keep doing this, right, for 10 years if you wanted to.
Yeah. Well, Brendan, thank you so much for spending time with us. This is awesome. Thank you for hosting us here. We don't normally have great gigs like this. This is great. It's really, your story is incredible, and what you guys are building is incredible. It's awesome to hear that you guys are still charging along, and I have a ton of confidence you're going to build something awesome. Maybe you already have. Congratulations, and thank you so much for being with us.
Thanks. This was fantastic. Thanks for having me.
Thank you, Brendan. Yeah, this is awesome. And I think Wistia is one of these companies that we admire in Boston, and it's just great to spend time with you and see how you guys built.
That's very kind of you to say. Thank you.